My name is Don Booter. I'm a Naturally Bay Area board member and an M&A partner in the food and beverage group at Davis Wright Tremaine, a national law firm. Welcome everyone to today's Quick Bites. Our topic today is food and beverage M&A landscape in 2021, challenges and opportunities. And we have a large attendance for today's event. Attributable probably to the topic and to the speakers, the panelists we have today. I'm going to turn it over to them in a few minutes to introduce themselves, but let me start by just laying out some of the format for the event. We're going to save about 10 minutes at the end for Q&A. There's a Q&A function on your screen, not the chat function, but the Q&A function. If you could send us questions as they occur to you, and if you can get them to us before the end of our panel presentation, that'll help us manage time for the Q&A. We may go a little bit longer if beyond the 12:45 or 45-minute threshold if we have a lot of questions, but we'll try to keep it to 50 or 55 minutes at most. And this is going to be a very interactive discussion among our panelists. We have about 5 or 10 questions that we've discussed in advance that we want to pose, and I'll try to manage the time so we can cover as many of them as possible. So with that, let me introduce Nick McCoy, Kevin Krouse, and John Marshall. If I could turn it over to each of you in that order to tell us a little bit about yourself, your firm, your practice, and what your target market is.
Hey everyone, thanks for coming today. I'm Nick McCoy, co-founder of Whipstitch Capital. We're the largest investment banking firm that just focuses on better for you, food, beverage, supplements, personal care, et cetera. We raise capital for companies, usually $10 million in higher checks, and we work with companies when they're ready to sell and finding them a buyer, as well as work occasionally with larger buyers to help them find companies to buy.
Thanks, Nick. Kevin, you want to go next?
Yeah, good afternoon, everyone. Kevin Krouse, I'm a managing director at Piper Sandler. For those of you who don't know, Piper Sandler is a full-service middle market investment bank. While M&A and capital raises are our core focus, we do offer a suite of services, including equity capital markets, and also have a $1 billion dedicated lending arm. Based in San Francisco, like Nick, spent all my time covering food and beverage and nutritional supplements. Over the years, been fortunate to have worked with many of these kind of high growth, better for you passion brands, advising them on their kind of ultimate transaction. So sold Justin's to Hormel, Conagra, or Frontera Foods to Conagra, Kicking Horse to Lavazza, and recently Smart Sweets to TPG Growth, and then Essential Water to Nestle. So excited to be here today and look forward to the discussion.
Thanks, Kevin. And how about you, John?
Yeah, again, thanks to everybody for joining, and thanks, Don, for setting up this panel. John Marshall, I'm a partner with BMG Partners, one of the more narrowly focused consumer products investment firms, expanding broadly into consumer as well. But for the last 16 years, have done 40 or some odd deals across food and beverage, personal care and beauty, pet food and treats, and wellness and supplements, and that's really kind of all that we've done, and focus very much on building, fostering, and supporting those ecosystems, both founders and entrepreneurs, professional managers that we partner with, as well as those in the broader ecosystem. So happy to support Naturally Bay Area as well.
Thanks, John. So what we're going to do today is look at this topic of food and beverage M&A in 2021 through a few different lenses. What strategic buyers are looking for, what financial buyers are looking for, where the hot categories are in the sector, and how 2021 is looking different than 2020, the year that we just survived, and what the future holds in store in the near term for M&A activity in this sector. And before we jump in, I want to thank Lizzie Elliott of Naturally Bay Area, who's behind the curtain making the magic happen. So thank you, Lizzie, for orchestrating this. So let me start off with a question that I'll pose to Nick. So I'm looking at 2020, obviously a very different year for all of us. How did the pandemic affect the M&A market and the food and beverage sector last year?
Great question. I guess as everybody expected, when the pandemic hit, there was a significant drop in M&A. We actually ran the numbers about a week ago just to look at this, and it appears that the number of deals on a monthly basis dropped down to about 40% of what they were in January or February. And honestly, I'm quite surprised they were that high, because I remember sitting there in April and, you know, watching every single process that was underway either fall apart or go on pause, or, you know, have something questionable happen to the business, you know, from the pandemic, whatever it might be, you know, inventory outages, manufacturer issues. So it actually kind of feels like that was a lot of deals getting done in April and May. Once we got into the June, July, August timeframe, those numbers started to climb again. And, you know, by the end of the year, the amount of deals, like deals in number, were actually about the same as January, February. What was distinctive is at the end of the year, the actual dollar volume was about double what it was earlier in the year. And you're seeing this with, you know, big deals like Nestle Water that was, you know, recently announced. There's a lot of kind of large M&A transactions from strategic to strategic, or, you know, private equity to strategic, or, you know, vice versa, that are happening. And we've also seen a lot of SPACs come into the market that, you know, those sometimes are counted as M&A, sometimes not, just depending on how they report. But once a SPAC does its first deal, they become generally voracious, you know, buyers for add-on deals, and that's definitely boosted things too. SPACs have nothing to do with COVID. It just seems very coincidental that this all happened at the same time.
Thanks, Nick. And Kevin and John, any observations looking back on 2020, how the year was different, and what you saw the trend line be during the course of the year?
No, I think it's pretty consistent with how Nick described it. I think we obviously put a number of deals on pause at the beginning of COVID, and we're really trying to kind of pull the market with respect to strategic and financial buyers in terms of kind of how are they evaluating these opportunities in the middle of COVID. And I mean, a lot of them were open to business and looking to deploy capital, and knock wood, we're all kind of covering this industry segment that for the most part benefited from COVID. So I think a lot of the businesses continued to perform extremely well, and that's when you started to see this cycle of some of these deals start to come to market, and we'll hit on it later. But I think it's been a really resilient marketplace in 2020, and kind of expanding into 2021.
Thanks, Kevin. And how about you, John, from the private equity perspective? How did you, again, in the M&A sphere, but what activity did you see or trends did you observe in 2020 that might be unique to that pandemic year?
Yeah, no, definitely saw everybody hit the pause button in terms of processes in process. I think though, and I have not run the specific numbers, but if I had to guess, I would say 2020 was probably firm-wide our most active year. Now, some of that is driven by you know, a venture capital effort that is, you know, not kind of large M&A driven, but you know, we had on the growth side of our business a very active year in terms of deploying capital, and as well as kind of harvesting. But as Nick alluded to, they were kind of larger deals towards the back half of the year, and I think that is something that we're seeing thematically that's not necessarily COVID impacted, but a real flight to scale and quality. And businesses that have strong business models. And I think we were fortunate that most of our brands are consumable in nature. So they did see that initial pop that folks waited a while for it to level out, and then resumed kind of more or less ordinary course, albeit fairly strange in terms of everybody doing business on Zoom.
Thanks, John. So let's move to the next question now, which I'll ask Kevin to kick off. And that's how the valuation metrics in the M&A market in food and beverage may have shifted in 2020 during the pandemic, and how different ends of the market may have been affected by that, emerging brands versus large-scale strategics. What were we seeing in terms of valuation that might have been different last year than in prior years?
Yeah, it's an interesting question. I guess moving aside some of these, I'll call them distressed food and beverage transactions that occurred in 2020, I would say we didn't really notice a meaningful difference in valuation levels kind of pre versus post-COVID. I went back and looked at a handful of transactions that we did. So Smart Sweets, Birch Benders, Essential Waters, where we pitched it actually pre-COVID. It ended up closing during COVID, and all of those, in terms of the valuation range, was kind of at or above our initial expectations. So it's been really interesting to see kind of how resilient the marketplace has been. I would say what we have seen is what multiples they're applying to varies. I think a lot of these buyers are bidding off of COVID adjusted net sales or EBITDA, where you've seen some of these businesses that had a big pantry load on the sales side, or just a lot of kind of reduced trade, marketing, travel that's driven incremental EBITDA. I think it'll be an interesting case study as we start to cycle some of these kind of sales trends here, just to see if it's actually been an incremental kind of increase in true consumption, or if it's going to return down to a more normalized level. But have seen a lot of buyers kind of bid off of some of these more adjusted numbers, but still applying kind of the healthy growth multiples that we had seen beforehand. So I think in general it's been fun to see that kind of the marketplace has done as well as it had kind of throughout this, and we expect that kind of trend to continue into 2021.
Thanks, Kevin. Nick or John, any views on the question of valuations in 2020?
I think Kevin hit the nail on the head in terms of, there's a lot to unpack around that initial March, April, May timeframe in terms of what a COVID bump actually was and the impact to the business. I think there's going to be a similar exercise related to potentially more on the working capital side for businesses that did see early benefits. If I take some of the household products businesses that scaled up, or businesses that converted some of their production capabilities, say, a distiller to making hand sanitizer, and now we all know there's way too much hand sanitizer out there, how they navigate those adjustments, as part of future processes on the M&A side of things.
And what's your view on it, Nick?
I think Kevin and Jonathan, they nailed it. I think one thing that I would just clarify for the founders in the audience on COVID bump, everybody's had some kind of a COVID impact, whether it's negative if you're in an on-the-go category, or heavy food service, or for most people positive in retail. And when thinking about kind of what is the whole thing here is what's the permanent revenue, kind of what is going to stick after COVID. And a lot of people some categories have had things that bumped really high up in pantry loading and immediately dropped. Then others have kind of stuck around a little. Like if you look at things like spices, they're still trending very high right now. But take a look at the category that you're in. Take a look at what you've done as far as product sales and how that's trended over the last few months, and also look at your out of stocks, because the out of stocks have been one of the biggest muddying things in the data in COVID. If you've been out of stock somewhere and lost distribution, then got it back 3 or 4 months later, those things are kind of hard to work out as far as talking to an investor or to somebody that's buying the company, what's kind of the real sticky revenue. But you have to look pretty broadly, more at the category level than at your own data, and then be ready to explain your own data.
That's a really good point. I just to tag onto that, I think for the founders in the audience, making sure that you're realistic with yourself about one, how likely you were to get new distribution that was potentially on the come that didn't happen because retailers canceled their resets. But on the flip side, how much distribution did you potentially keep that you had but weren't earning? So next point of diving into the data and understanding your velocities relative to your competitive set, and making sure that you're presenting a realistic picture, not just an M&A process, but from a business and operations process as well.
Thanks, John. So next question I want to pose to John to start the conversation, which is, which product categories within food and beverage seem to be the hottest from a transactional perspective, primarily M&A, in 2020? Did you see any kind of grouping or trending within that, looking at it through that filter?
I think speaking specifically to our business, I would say we saw quite a bit of personal care. I think that is we are a very small subset of the deals that got done. But I think pulling back maybe thematically as opposed to specific product category focus, the things that we're continuing to see resonate with consumers, which then leads to what is interesting from an M&A perspective, are, this trend towards using food as medicine. So digestive health and skincare, food really going functional. And then, no surprise to anybody on the call today, but anything and everything plant-based, both from the traditional kind of healthy living, but also, increased focus and attention on social responsibility. And then one that actually took, and maybe this is my personal perspective, but as the early months of COVID took a bit of a back seat, but is now coming back in 2021 with significant interest, is kind of the low and no categories as a whole. So things that are low sugar, no alcohol. The wind got sucked out of those sales that were blowing pretty strongly at the pre-COVID, as people were sitting at home with not a whole lot to do other than indulge. I think 12 months in, folks are returning to some of those trends in earnest and refocusing on the healthy lifestyle aspects.
Thanks, John. And Kevin and Nick, any views on that question? What product categories seem to be hot in the sector right now?
I'll start. I think John got a lot of them. I mean, I look at people ask a lot, what's going to be kind of like or what's the big category? And I think a lot of it is white space, and just kind of where is innovation kind of happening at a given time, particularly on the funding side. On the M&A side, it's a little bit more of a lagging indicator of, where was the white space 4 or 5 years ago for companies to kind of grow large enough to get bought. Personal care, I think, is really interesting because a lot of personal care didn't get the M&A or didn't get the COVID like stockpile. So it was a little more even when you look at, kind of what happened to sales. People weren't stockpiling, facial cleanser or whatever, unless it had an antiseptic component, of course. It had 60% alcohol. But yeah, I think those are pretty much it. I would just add, and the social responsibility, I'd add sustainability too. I think that's definitely a growing theme too this year.
Great. Thanks, Nick. Kevin, any final thoughts on that topic?
No, I think that's right with respect to product categories. I think you're seeing a lot of these digitally native kind of D2C businesses go from 0 to 50 million almost overnight. And I think that plays again across all the product categories that we've highlighted here today. But I think that model and trying to unpack that for the strategic buyers that historically kind of haven't played in that space will definitely be a focus area for people on a go-forward basis.
Okay. Thanks, Kevin. So let's shift our lens forward now to 2021 and perhaps heading into 2022. What do you think that strategic buyers are looking at now in the M&A market? What kind of targets do you think are likely to rise to the surface for them? And Kevin, do you want to give your initial impressions of where the strategic buyers seem to be focusing heading into this calendar year?
Yeah, sure. So on the strategic buyer front, I mean, I'd categorize their appetite and interest in M&A kind of during COVID and heading into 2021 as, open for business. Really across the board, most of these large strategics have been able to generate a ton of cash. They paid down debt, and they're actively looking to acquire brands to kind of evolve their product portfolio. In general, I've been impressed with their kind of willingness to engage in these virtual M&A processes. And in many instances, I mean, they're doing these deals 100% virtually without kind of sitting down and meeting the founders in person, which I think just speaks to their commitment to continuing to execute on M&A transactions in general. And I'd say, I mean, heading into Q4 and then really into Q1, I'd say we've seen a sizable uptick in kind of deals hitting the market. I think in talking with these strategic buyers, I'd say their screening criteria has really risen as they're trying to evaluate so many deals that historically maybe they were looking at 2 to 3. I mean, they're getting bombarded with opportunities. So I feel like it needs to check a lot of boxes for them to really engage. But once they do, they're full steam ahead, which continues just to speak to their overall commitment to that. And I guess with respect to valuation, I mean, I still think that they're paying premium prices for assets that they want to own. And if they want to get aggressive, they can obviously kind of outbid the broader buyer universe.
Thanks, Kevin. Nick and John, any thoughts on that topic?
I think Kevin's perspective is right on. I think One of the things to think about with the very big strategics is they've got a really, decades, centuries, whatever level playbook that's been developed in knowledge base around building big brands. And that's what they're really good at. And I think over the last, you can look at the data, over the last 5 years or so, the average size of an independent company in CPG when it gets bought by a big strategic is about doubled. And by size, I mean revenue. So, they really like the kind of 150 million and higher, revenue levels. And you're seeing that in these kind of headline larger deals, like, the Essential Water deal that was mentioned. It's companies that are kind of that size. They're comfortable because they know they can grow large enough to be meaningful and, not get kind of lost in the system. They can get the capital budget allocations. They can get quality brand managers on them. And then we have this layer of SPACs and, private equity buyers and things that are buying off of EBITDA primarily. And if you're 5 million EBITDA or higher, there's a lot of people that are looking at, either new platform companies by combining two companies in a category or adding on to something that they're already building. And that's a nice layer of buyers for companies that aren't at that 150 million level or have a niche brand and you don't want to, cut your price 30% in your margins to try to get to that level. Instead, you can hold it a little bit smaller and make money along the way and raise less and sell for a great multiple right now on EBITDA.
Yeah, I would say, I don't know that it's 2020 specific, but it's the last couple of years of trends of, the strategics, and not every one of them, but by and large, that kind of flight to scale and flight to quality. I think they're taking less, they're making fewer bets and more kind of risk adjusted bets on things that are certain wins. But for those assets, to Kevin's point, they continue to pay strong prices in and around historical averages of about 3 times revenue and 20 times EBITDA.
Thanks, John. So the next question I'd like to pose to you, which is the perspective of financial buyers in this market. So private equity firms like VMG, how are financial buyers assessing the market now into 2021, and what are they looking for, and how is that different from what their filter has been in the past?
Yeah, and I'd probably speak maybe a little bit to what I perceive as the competitive dynamics and how others are operating, which I'm not inside their shop, so I don't know specifically, but they're, in terms of just the quantum of dollars out there needing to get deployed with a fund cycle against it, it's bigger than it's ever been. It's, north of $1 trillion of private equity capital. And then you layer on top of that a financing market that has had persistent low interest rates and is likely to continue in that vein for a while. And this COVID stimulus, which is going to have some impact in terms of 1.9 trillion, 2.2 trillion going into the system, even at the consumer level, supporting the economy broadly. I expect we'll continue to see really high prices and strong demand for assets, and both in terms of the strategics, but also private equity sponsor-driven businesses for the larger deals that are looking at layering on significant amounts of leverage that is available from private debt funds and banks that are looking for a return on equity or even a traditional kind of multiple on their capital. So we continue to see our competitors in the private equity space be really aggressive in terms of values often, and Kevin can probably speak to this in terms of the Smart Suites deal a little bit, but where they're competing with strategics often in terms of the values that they're able to pay, and kind of penciling in returns that still make sense for their LPs.
And so just to create a frame of reference for the viewers, and you find still that strategics are willing to pay more than financial buyers in this market? Or is that last point you were making that you're seeing the gap close a little bit?
For certain assets, I would say that the financial sponsors are very competitive with strategics.
Right. Kevin,
I would agree with that completely. I think we've seen in multiple of our processes where historically maybe we were running a strategic only process. We've been encouraging our clients more often than not to include private equity. I think on Smart Suites, or even going back a couple of years in terms of Yasso and some of these deals, I think they're there are private equity groups that are very focused on growth and can kind of get past that hurdle and kind of bid off of a forward multiple and kind of get comfort with the growth profile, and in some instances kind of outbid the strategic buyer universe.
I think it's probably fair to say that if you have a 20% EBITDA margin, getting that 15x, which gets you to a 3x, net revenue multiple, it's fair to say at that point you're going to have a lot of competition with sponsors.
I would also add, and Nick mentioned this earlier, and again, it's a bit of a gray area where it falls, but I think the entry of SPACs is a piece of the process, whether it is a private equity sponsor who pays up for a deal and then sees it going public downstream in a more efficient manner. There's currently is an arbitrage there that you can pay up for on a multiple basis for a private company with the prospect of going public via SPAC that is allowing them to get to higher valuations potentially in their models, because SPACs are looking at 2025 revenue and EBITDA numbers as opposed to even 2021 or 2022 at this point.
Thank you. So let's shift our lens now to maybe the smaller end of the market and companies that are in the, say, $20 to $50 million range. And we can talk separately about the companies over 100 million. But a lot of our emerging brands in naturally Bay Area aspire to get into that range, want to think about how buyers would be viewing them and what metrics would apply, what would attract buyers when they're ready to exit in that sales range. So Nick, do you want to weigh in on that question? What you think either strategic or financial buyers are looking for from those emerging brands at that end of the market?
Sure. I think, I think the $20 to $50 million revenue range, again, kind of falls below that 100 plus that the very large strategics look for. I think if you are somebody who is redefining a category or you're incrementally growing a category, and that category has enough headroom that you can easily see yourself getting there, and there's enough defensibility on your brand that there's not going to be 5 other brands like hand sanitizer or something, right? There's not going to be 5 other people chasing your tail in 2 months. That can be actually very interesting to a larger strategic early. I think no matter what you're selling to, whether it's a financial or strategic, the headroom on your brand, and by headroom I mean if you look at where you're selling today and which channels you're selling at, and basically looking at analogs of larger, better for you players, how many SKUs can you expect to get on average? And what's a realistic velocity based on the others that you can get, and what ACV, what level of distribution in the channel? Is it 40% of doors, 50? And look at your headroom that way. Don't assume that you're going to break into convenience if you're not there, or you're going to have a second subcategory. You're in frozen now, and you're going to be in snacks and produce, and you can't assume those things. It's very narrowly look at where you are, and figure out your headroom. And if that headroom number is above 100, that's a really big positive. If it's not, and your headroom is 40 or 50 and you're at 20, if you're able to run at something like a 15 or a 20% EBITDA margin, the EBITDA multiples are very good when you get above 5 million, and they're even better when you get above 10. There's a lot of companies that are selling for 10, 11, 12 times EBITDA when you approach 10 million of EBITDA, which makes for a good exit when you've got a nice niche brand with a good gross margin.
That's a great point. I think for some of the maybe earlier stage businesses on the call or on the video chat, I think continuing to focus, and we've said this for a long time, broad rather than deep, focusing on driving velocities where you are in the product categories that you're in, as opposed to going too broad and trying to spread yourself too thin, is still kind of rules the day, and that will allow you to drive those higher EBITDA margins that Nick was alluding to, because you don't have to build the army before the war. And then you have the opportunity in the process, if you do get to that, call it $50 million range, to articulate a white space total addressable market growth strategy that you haven't necessarily had to execute on fully, in be it convenience, be it entering another market, be it expanding the product category. And you get some credit for that. You get more credit if you've actually put some points on the board, but not entering those markets and failing is often better than spreading yourself thin across too many different initiatives.
Yeah, I think that's well said. I think we see more often than not companies that kind of blew out distribution, didn't have the marketing dollars or the trade dollars to support that. And as they're going through a diligence process, the question inevitably pops up in terms of, have you lost distribution? And typically it's they lost distribution because they weren't focused and they were kind of spread too thin in terms of their overall strategy. So I think, to John's point, in terms of going deep with your customers, making sure that the brand really performs well in your core retailers, definitely resonates with buyers as you're kind of going through a process.
Well, one point John made that I think is really relevant is this driving velocity. You know, at the end of the day, velocity is kind of your ultimate report card. How many are you selling, you know, in a store per SKU per week? And if that number is going up, you're obviously doing something right with marketing and things. And one question that I get a lot is, you know, what's better? Should you increase ACV? And, you know, if you're suddenly getting attention of buyers, it's very seductive, right? You can get X amount of doors at Walmart, X amount of doors here and there. And obviously, the more you increase ACV quickly, the more dilutive it is to your velocity, just because you spread yourself, you know, above your customer base very quickly. So we actually took a look at the other strategy, which is building brand block. And that means how many SKUs do you have per retailer and which is better strategy. And we actually ran the numbers using SPINS data. And we figured out that when you increase brand block, the more you increase it on average, it is dilutive in that first year. But in the subsequent years following, it's actually accretive to the point that it more than reverses the dilution. So if you're thinking about getting in front of an investor or somebody you're selling to, you know, 24 months out, and you want to have a nice velocity trend that has an uptick on it, building your brand block now essentially it's almost like putting a marketing piece on the shelf, because you're big enough that people notice it and they keep walking by and they keep seeing it, and eventually they buy it because you're just big enough to get the attention in a conventional grocer. And you see that in the numbers. It builds a nice rising tide.
So Nick, could you talk a little bit about brand block and what that means for emerging brands?
Sure. So a brand block is basically how many of your SKUs do you have on a shelf? And it's, you know, there are certain categories where, you know, if you're in like salty snacks, I look at a brand like Late July as a great analog for how big of a brand block can you get and better for you. And remember, Late July is DSD delivery, which is direct store delivery. So they're going to get more because they're making it really easy on the retailer by stocking their shelves. So they can say to the retailer, hey, we're gonna continue to do this. You don't have to lift a finger, give us another SKU, and they will. They're at about 8.5. And in 2 or 3 years ago, they were in the 6s, and that's the effect of DSD. That's building their brand block. By having more SKUs on the shelf, you have a bigger visible brand. If you're in the center of store, something like hot sauce or baby food, you might have an average of 25. I think Berea pasta is 40 on average SKUs. If you're in freezer, you see a lot of these frozen better for you brands like, the Amy's of the world or Prager's and things. And you'll notice that they have 5 or 6 SKUs per subcategory, but they might be in 7 or 8 subcategories total. And if you go to a place like Target, they'll line them all up in the same freezer doors. So you actually have this like really big brand block across doors because you're in multiple subcategories and they're smart to put them together. So those are the different ways I look at it.
Thanks, Nick. Very clear explanation. So our last question before we'll move into the Q&A is really about timing in going to market. And a lot of companies were drinking water out of a fire hose to keep their supply chain and their distribution humming in 2020, and maybe didn't feel they had the bandwidth to turn to an M&A market last year, maybe more, or this year. Maybe some are thinking, let's wait another year until we're in the post-pandemic environment to go to market. John, do you want to start with your thoughts about timing and whether that will play a factor in valuation and success?
Yeah, happy to. So I think it's somewhat dependent on product category. So I think folks trying to sell hand soap businesses this year may have a hard time disaggregating the COVID bump and getting the bids that they would like to get for their businesses. I think you probably have a lot of folks who are looking at their bottom line and what they were able to generate last year and applying the multiples that we've talked about here and saying, well, that's a good number, let's go get it. And I think they go and talk to be it strategic or financial, and folks want to make sure that it is sustainable. That doesn't necessarily mean that you shouldn't go. It just means that if you had a steady, stable business that was growing pre-pandemic and it did well during the pandemic, timing is plenty good now. The markets are very active, both public and private, and so it's probably worth taking a shot if you feel like the timing is right for you now. If you had a break-even business pre-pandemic that then generated 10 million of EBITDA in the pandemic year, it's going to be tougher to get full value for that pandemic year performance.
Thanks, John. Nick or Kevin, any thoughts on that question?
I mean, I think the way that we've been trying to counsel it to our clients is, listen, if remove COVID from it. If you feel like it was the right time to take your business to market, then it's the right time to take your business to market. I feel like a lot of these companies have either, maybe it was private equity owned and it's a diversified fund and they were going to sell an industrial business and they're like, oh, we have a food asset that's performed well, let's take it to market. Or you have the entrepreneur that's like, we survived COVID, we're recession resistant, like let's go to market. And those are the deals that are, I'm going to call them like B plus assets that I feel like struggle to get traction. I think if your business is continuing to perform well with good margin and there's kind of a sustainable growth strategy and traction towards that, then those assets will continue to transact, and there's good kind of appetite for that. I feel like there's just so much in the marketplace that it's kind of hard to see kind of through all the weeds, just given kind of what's out there. But I think for businesses that have kind of sustainable growth and nice margin, there's always opportunity.
Thanks, Kevin. Nick, any final thoughts on timing?
No, I agree. I mean, I think pulling the kind of short-term viewpoint of COVID out of the decision, as much as you can, I think is really important. And, to Kevin's point, the growth story, look forward at what do the next couple of years look like, and, how well can you substantiate that growth? And if you feel like you can do it with some data backing, and the momentum of your own data for the last few months, then you're ready as a founder. I mean, again, this is, these are very personal decisions for a lot of people, both founders and investors, right? I mean, they have a vested interest in all their portfolio companies. So it's, there's that aspect too.
Okay, thanks, Nick. So let's pop into the Q&A now. And I will try to keep it to about a minute for each question. Looks like we have about 4 or 5. So the first question that we have here, and any one of the panelists can jump in. I'm an owner of a smaller brand. How do I start the process of adding to the team with a new strategic partner? Is there a blueprint to follow and places to reach out to find someone who might be interested? Any thoughts?
I'm trying to determine whether it's team members and growing staff, or whether it's about adding say an investor. But if it's the former, I would say selfishly we're happy to help. You can reach out to VFG and our talent team, and we can see if there's anybody in the Rolodex that fits. And then I would, I think even mining LinkedIn for folks who have had success with competitive products is a pretty fertile hunting ground. If it's about raising capital and bringing on an equity sponsor, I think it's a lot of what we talked about today is applicable to a earlier stage business, but it's about the growth plan and the trajectory and what the next few years look like, and creating a compelling pitch for your business to an equity sponsor to come on board. But
thanks, John. Any other thoughts on that one before we move to the next? Okay, our next question has to do with early stage valuation. So with investors coming in and into seed rounds, convertible notes or safes, slightly different topic than M&A, but let's get a quick read on what you're seeing for valuations from the investor side with early stage companies. Any quick thoughts on that?
I'll start, I guess. There's unfortunately not a great database of these things out there. So, what you pick up on is kind of what you hear, anecdotally from private sources. I don't feel like the valuations on earlier stage companies have moved that much, but I do feel like there's been a little bit more of, kind of a binary aspect of the ones that are easily getting funding and the ones that aren't, particularly at the 5 million and less check size range. So I think, the earlier stage companies that have a broader board, or have people as advisors, or partners in the industry, whether it's an outsourced sales or something like that, that have track records or have value add in their category or with their business model. I think that really helps a lot, partially just because you have those networks, but partially because your team is beyond you, and operations is dauntingly complicated. It's always amazing to me how challenging it is, watching people run these companies. So that, I think that's probably what I would say to it.
Great. Any other
I
thoughts?
I would just add, generally, in this works often against VMG, but avoiding pricing or avoiding raising capital for as long as possible behooves the founder, right? That's how you generate real equity value for yourself ahead of taking on a capital partner that's going to be dilutive to you in most events. So bootstrapping for as long as possible is advice we often give, because it's the right thing to do for the founder and the entrepreneur. I think in terms of valuations, Nick's spot on in that it is there are two kind of key factors in my mind that I think about on really early stage opportunities. It is the quality of the team, and whether that's the board and advisors surrounding the team or the folks working in the business. Very paramount. Kind of 1A is then the total addressable market that you're targeting and kind of what you're going after, and that is reasonably correlated to the valuation you can expect to receive. If it's a low total addressable market, that's fine, but it does place a premium on what Nick talked about before, and in terms of the business model and making sure you're getting to profitability quickly. And if you're going to be small and profitable. If you're going to be large, you have maybe a bit of a different opportunity to go after a bit more of that scale and have the profitability come on more strongly later on.
Great, thanks, John. So I think we'll have time for a couple more questions. The next one is about M&A trends in the supply chain. So earlier, supply chain to food and beverage companies, what kind of activity are we seeing at that end of the market? Any thoughts, any one of our panelists?
I've seen a bit of a trend, and I mean, this is probably N equals 7 or 8 now, of co-packers that are merging with branded product companies that are, generally on the smaller side, let's say less than 30 or so million in revenue, particularly where they're meaningful in size to the co-packer or strategic to the future expansion of the co-packer. So if they're looking at building a new plant in some state and they could fit really well there, taking a substantial stake as part of an equity round, or even in some cases, buying them.
My own perception is, we've seen this incredible, if you just take Expo West as an example, 10 years ago, it was under 5,000 exhibitors. Now it's close to 10,000. There's been this enormous explosion in the number of brands, and a lot of that is driven by people narrowing their concepts and using similar co-manufacturers for similar products. So there's been this explosion of brands that are appealing to a smaller and smaller niche target consumer, which is great because the consumer wins and is getting what they want. It creates a ceiling limitation on the total addressable market for a lot of those products. And it makes some of those co-packers winners as well, because they're producing the same product for many different brands. I think what brands will need to do in the future is probably look, and not every brand should do this, but look, as Nick said, more towards some component of vertical integration to provide differentiation across their operation and innovation capabilities. But that's, that's something I could see coming down the pike. I don't know that it's fully here yet, but Nick's obviously seeing it happening in a handful of cases. So I think folks are paying attention to it.
Yeah, I think on the co-pack front, it's been interesting. I think you have a lot of these private equity groups that want to play in these thematic themes around kind of better for you or even beauty and personal care, where they're not going to pay the growth multiple that some of these kind of growthier private equity groups or strategics are are willing to pay. So they're able to play the trend by investing in the co-packer or an ingredient supplier and be able to participate in that industry theme. And I think increasingly we've seen a bunch of guys continue to focus on that as a way to just participate in the broader category.
I think Kevin's point, just real quick, is very good actually, and I'm so glad that you mentioned that, because co-packers and private labelers, co-packers, they tend to be profitable more early on than brands. So because they have that EBITDA line at younger levels historically than brands, like $10 million, you can have whatever, $1 million of EBITDA. They tend to be appealing to these private equity buyers, which are very EBITDA focused. So if that's kind of in their DNA, and that's why you see a lot of the roll-ups, as he was alluding to.
Thanks, Nick. So I think we'll have time to get to one more question. We have a number that have come in the last few minutes. So we'll try to get to those online after the event, and apologize for not being able to get to all of them during this call. But the last question I want to pose to the panel is, can you comment on a direct-to-consumer brand's ability to exit without traditional retail distribution? Assume 50 to 100 million in revenue. What are you seeing in that category?
So hard to say. If it's 50 to 100 in revenue and profitable with a good lifetime value to customer acquisition cost ratio, then probably pretty good. What I would say is, or I guess a follow-up question would be, what's keeping you from going into traditional retail? I think what we've seen and where we tend to focus is truly omni-channel businesses, or where the strategic acquirers want to be. And so if there's something about the product that precludes you from being able to go to retail, that maybe limits the headline value that you'll receive. If it's white space and you can get a couple of those points on the board, I would try to put the points on the board probably, because that'll give an indication of the total addressable market. And our perspective at BMG is that we want to be everywhere where consumers are shopping, and that includes having DTC components to all of our businesses, as well as being available in offline distribution.
Yeah, I think that's right. I think you've seen probably more so on like the beauty and personal care, where there's been more of these digitally native D2C businesses that have really ramped and kind of exited. I think from a pure play food and beverage perspective, we're probably in the early innings of the growth profile there. So I think to John's point, if you're able to grow and scale D2C and obviously do it profitably, that's phenomenal. I think your ability to expand to incremental challenges or incremental channels will just make you more attractive to the strategic buyers that understand those channels and say, listen, well, we can take the distribution from X to Y, but we don't really know how to execute on your D2C strategy.
Thanks, Kevin. Nick, any final thoughts?
I think John and Kevin, pretty much nailed it. One watch out I guess I've seen is if somebody is pure D2C, a lot of times that success can be driven by influencers, and it really kind of stemming from the founder being the brand. Like the founder is actually almost a celebrity, and whatever it is, gluten-free or whatever that they've started the product in. And to the extent that the founder is so tightly knit with the brand, it can be perceived as a risk factor, particularly by large CPGs that kind of have their core in retail. And then I think, the point on the LTV to CAC and ratios like that is really important. The incremental CAC, or what's happening in your CAC as you're trying to expand and grow more quickly, is a really good forward-looking indicator for how large you can get in D2C. And so I think keeping an eye on that too is really important.
Thanks, Nick. So I want to thank our panelists for some really terrific insights today. This for anybody who wants to go back and hear them again, there will be a recording of this posted on the Naturally Bay Area website. And the questions that we have not been able to answer, we'll try to answer online in the next couple of days. So thank you to all the participants. Thank you very much to Nick, Kevin, and John for participating as panelists. And we look, each of their email addresses will be available on the posting in Naturally Bay Area with the recording. So if you want to reach out to them directly for further conversation, please do. Thank you, everyone. We'll look forward to seeing you at the next Quick Bites, and thank you again for participating. Be well.